Hello everyone. So today in this particular lecture, we are going to start with a new area called as cash management. In the working capital management area, there is a small area called as cash management. So we are going to start with the area called as cash management in this particular lecture. With regard to the cash management, only there are two models in this which they will ask in examination. One is called as a Baumol model. Another one is called as a Miller-Orr model. Baumol model is very frequently asked in exam. Miller-Orr model, there is no question that has been asked, only theory questions they will ask. But still, I have created one problem taken from one of the past RTB questions. If at all in exam a question has to come, it will come in that way. Okay, I will show you both. If you done the three problems I have kept here, if you can do all these, any kind of question that comes in examination with regard to this particular cash management, you will be able to solve. Okay, this lecture I will try to complete just in 40-45 minutes, such that even at the time of examinations you will not feel any pressure. Notes, if you want, you pause the lecture, write the notes. Okay, but I recommend you to write the notes such that it will be having in a text format with you. Okay, let us now begin with the chapter called as cash management. Okay, see the screen. Okay, see there. What is the topic we are going to discuss now? Cash management. Okay, see here. Firstly, I will press to the concept. This concept of cash management is similar to that of inventory management concept, which I already covered. Okay, in this chapter we are going to deal with two areas. One is called as a Baumol model, another one is called as a Miller-Orr model. Another one is called as a Miller-Orr model, ORR. Okay, Baumol model and Miller-Orr model. So Bowman model and Miller-Orr model, in this Bowman model is identical to that of the EOQ concept, which we have already covered in the inventory management, means in a inventory management we have already done with a concept called as a EOQ. EOQ means economic order quantity. At what order quantity the holding cost and the this particular inventory carrying cost, and that means a holding cost or ordering cost, both will be at a minimal level. Technically we can also call this as, we see in such a order quantity where we will have ordering quantity and the holding cost. Ordering cost and holding cost both will be alike. That is the area called as a EOQ, economic order quantity. Like EOQ, there is a concept here called as a optimum transaction size, OTS. What is the concept? OTS. What is the full form? Optimum transaction size. Why optimum transaction size is required? What is the concept of this optimum transaction size? How it will be useful for us to understand? Let us try to have a clarity. What is the model we are going to start first? Baumol model. Next one, Miller-Orr model. Okay. Before we go into Baumol model or Miller-Orr model, first let us understand certain insights behind this concept. Okay. Baumol model is identical to EOQ. Miller-Orr model is the cash budget approximation concept. Cash budget approximation concept. How it will be, everything I will explain with a formula. First, let us see this. Next. First, before even going into this, I will give you an example. So why this cash management chapter? What is the idea behind this? A company is there. That company require, say for example, 50 lakhs amount of cash. How much cash, sir? 50 lakhs amount of cash to run its business throughout a year. 50 lakhs cash I require today, na? I require after some time, after some time. First listen, if I put stock of raw material, there is a common sense. Stock gets converted into the sale or in the form of debtors. Why I maintain debtors? To promote credit sales and promote the sales in turn. Today in the world, if you see, all everywhere EMI's concept is there. Everywhere people are interested to buy on credit. Why? Because payment need not be made immediately. They can postpone the payment. Also, they may convert it into EMI. Okay. So credit transactions are very popular. Try to understand, because of doing the credit sales, bad debts will come. Just because of the reasons bad debts will come, company can't compromise in doing the credit sale, because once you promote credit sale, if 100 people buy in a cash sale, 1,000 people will buy in a credit sale. On a large mass basis, if you see that bad debts are very small. That's why most of the companies will offer a credit sale. So my question again, let's come back to the main discussion. Listen, point number one, if I put the money in the form of stock, or if I put the money, let's come from the beginning. If I put the money in the form of land and building, it generates rent. If I put the cash in the form of plant and machinery, it will generate sales and revenue. If I put the money in the form of debtors, it will be realized into cash. If I put them, it will promote the sale as well. If I put the money in the form of stock, it will be turned into debtors and sales. If I put the money in the form of receivables, it will be received in the near future. Every single thing, whatever I have done now, there is a use of making the cash to get converted. You see a land and building and tell it is a land and building of 1 crore. I will tell it is my cash blocked worth 1 crore. My cash is 1 crore worth of cash is blocked in the particular building or not? Yes. Therefore, what you have to understand, you have to understand that always whenever I say land and building, don't call it as a land and building like any other typical person. Call it cash blocked worth 1 crore. Rather than calling it as a land and building worth 1 crore, it is a cash blocked in the form of land and building in the mission in the business. Clear everyone up to here? So this is the first part of discussion I want to make. So every asset you maintain, whether it is land and building, plant and machinery, okay, or you are maintaining debtors, stock, etc. Everything has a use. But what is the use of maintaining physical cash balance in the company? When I say cash management, really cash, not even in the bank accounts. Cash, it is there. Okay. Why companies will maintain cash? They will maintain the cash for four purposes. Sorry. They will maintain the cash for how many purposes, sir? Four purposes. Companies will often maintain the stock of cash. Why? See there, I have given one example. Suppose a company raised capital of rupees 10 crore. Out of the 10 crore, 8 crore is invested in fixed assets. That balance 2 crore, 1.8 is blocked in stock, debtors, etc. The balance 20 lakhs is held in cash. Every asset must have a use. For example, plant and machinery is an asset used to generate sales and make profit. Stock of raw materials promote the sales. Just now I told you that. Sir, what I told, I have written there. Okay. Next. What is the use of the keeping of idle resource that is a cash? What is the use you will get? What purpose will it serve? Is a question of, it's an obvious question everyone will raise or not. So what is the purpose of maintaining the idle resource called as a cash in your company? What advantage you are going to get because of that? Motive number one, transaction motive. What is the motive number one? Transaction motive. I will tell you what is this transaction motive. Sometimes you should understand, I have to receive cash from my debtors. Okay, I have to receive cash from my debtors. If I am a debtor, what will happen? I have to pay to my creditors. My inflows, my outflows. If I have to receive something, it is an inflow to me. If I have to pay to someone, it is an outflow to me. I have 1 lakh inflow. I have 1 lakh inflow. I have 2 lakhs outflow. Means, say for example, 1 lakh inflow is there. 1 lakh outflow is there. Now what will happen with this 1 lakh inflow? I can pay this 1 lakh outflow. Here, the problem is not with the quantum of the amount. Here, it is a problem about the timing. Timing means what? I have to receive after 10 days, but I have to pay today itself. If I have to pay today itself, you to your creditor, you can't tell, wait till my debtor pays. After he pays, I will pay you, means he will kick you on your face. So you can't argue saying that I will pay you once my debtor pays pays me means it is not a proper common sense logic of a sound business principle. So you should not do like that. I repeat, always you can't match inflows with outflows. Amounts may match, timing may not match. Timing may match, amounts may not match. Both also may not match. Example, I receive 1 lakh. I have to pay 1 lakh. I receive after 10 days. I have to pay tomorrow. Timing matching is not done. I will receive one. Listening everyone. Okay. I will receive today. I have to pay today. But I will receive 1 lakh. I have to pay 2 lakhs. Again, timing is matched, but the amount and quantum of money is not matched. Third case, I have to pay today. Okay. I have to pay today. I will receive after 10 days. I have to pay 5 lakh. I receive 2 lakh after 10 days. Both are not matched. When matching is not done, you can't ask your creditors to wait till the timing is matched or till the amount is matched. They will not do the business here. Your business will get affected. Therefore, to maintain proper transactions, often we will keep idle cash, though we know that it is idle. Read this point. Very important theory question here, please read properly. Four motives they will ask in exam. Motive number one, transaction motive. Motive number one, transaction motive. Motive number two, compensatory motive. Compensatory motive. Sir, what is this compensatory motive? See here. For the banks, there are two types of customers: general account customers, high valued account customers. For example, yeah, I will be doing, I will be doing a lot of business for a bank. Means I will be keeping every month minimum 20-30 lakhs in the bank account. By keeping your 20-30 lakhs in the bank account, what will happen automatically? Bank will earn lot of interest. Bank will earn lot of interest. Okay. See the second example. No one will put 20-25 lakhs in bank account. They will put in business. But some accounts like Dutch Bank, etc., they will ask a minimum account balance of 2 lakh rupees to be maintained for the commercial customers. Normal account na 10,000 they will block. Commercial customers ki 2 lakh they will block. Means what? If you have account for 10 years, for 10 years period, your 2 lakhs is blocked with the bank or not. On that you will be getting only 4%, 3%, etc. on the minimum account balance. But they will turn the 2 lakhs for 2 lakh times in the 10 years at a rate of 10% or 12%, earning them a huge interest of your minimum account balance you are maintaining. Those people are called as high valued customers for the banks. For the high valued customers, they will give free services. They will give free services. What services? They will tell that, sir, your EB bills, electricity board bills will be there. Na? We will pay on your behalf. Tell the date. On the day, we will only dispatch the payments. Okay. Your employee payments are there. Na? Our bank will take care. Your TDS deductions are there. Na? Our bank will take care. Your internet transactions are there. We will not charge any commission on that. Like this, they will provide lot of advantages to the high valued customers who banks will provide. When banks will provide, if you put that minimum balance in their account, then they will do all these. Means that loss of that particular 2 lakh to be invested somewhere is giving you these benefits. Okay. That means you are losing your money. 2 lakh rupee you are losing and you are keeping in a bank account. Okay. You blocked your amount. Compensatingly to that, they will provide for services. I should never tell free service. They are not doing anything free. For the blocked fund, they are doing free. Okay. That's called as a compensatory motive. Read this compensatory motive as well. 2 minutes time I will give. If you want, you write down summary of this compensatory motive. Completed. Let's go to the next one. Next one. So two things we completed. What is the motive one? Transaction motive. Second one is compensatory motive. There is a third motive. This is called as precautionary motive. What motive? Precautionary motive. What is this precautionary motive? I have a motive to, okay, to maintain some amount for unforeseen contingencies. Means anything may happen in future. How will you know that COVID will come, before March 2021? Sorry, March 2020. Do you know? We don't know. Suddenly it came. Everyone has suffered a severe cash distress. Why? No proper precautionary measures taken before. Okay. For sudden occurrences, unforeseen contingencies, if you don't provide the cash balances with you, you will suffer a lot, or we have to beg with others at that time, which so many people have done during the COVID time. In order to avoid all those unforeseen contingencies, companies will maintain some amount of cash as a precautionary measure. As a precautionary measure. That is another reason. Okay. This is the next point. After that, the last and final one is speculative motive. What motive, sir? Speculative motive. Speculative motive means what? It is also having a motive, but with a speculation. Speculation means what? Sudden chance of making a gain is a speculation. So what sudden chance will be there? I will tell you. See here, some companies will announce sudden fall in prices. If you buy today, not in credit, in cash, if you buy, we will give 30% discount. That means they want money, you want cheaper goods. So you will buy one unit at 1000 rupee. On a particular day, they made an offer, open offer they have given, that we will give 30% discount. If you pay in cash today, immediately you went and paid in cash. So that 30% benefit you will get only if you pay in cash. For that speculatory transactions, which may be unforeseen and occurring, companies will maintain cash balances. That is called as which measure? Precautionary measure. Sorry, speculative measure. Also called as a speculative motive. Read those two also. Okay. Next. So this is the intro to this particular chapter called as cash management. From here, the problems will start. Very easy. Properly, if you listen to the discussion what I'm going to make now, you will not get any kind of doubt with regard to the application of cash management here. Listen carefully. First explanation. Don't see the notes. First explanation. What is the idea behind this cash management concept? They say like this. Every company wants cash. Every company wants cash. Whenever they want cash, they can't put 50 lakhs cash in the form of, see, 50 lakhs, 60 lakhs, 1 crore, 2 crores cash. They can't keep it idle in the form of physical cash here. So they will put somewhere else, and whenever they want, they will take out. Am I clear or not? They can't put in current account because they don't earn any interest. They can't put in savings bank because valuable money they can't invest at 3%, 2% interest rates. Therefore, what generally companies will do, if you have full amount of cash, I will put that cash in the marketable securities. What securities are? Marketable securities. What is a marketable security? Any security which will be immediately converted into cash is called as what security? Marketable security. Whenever I say marketable security, it will be immediately converted into cash. Those are called as marketable securities. Up to here, everyone understood the point clearly? So, marketable securities will be there in the market. They will put in that. Whenever they want, they will sell the marketable securities and get the cash back. Okay? But there is a problem. how much amount I need to put in marketable securities, when I should sell them and get the cash, how many times I should do this activity is an important thing that we need to understand. Three things I said. How much money I should keep in marketable securities, when I should withdraw from them by selling them, how many times I should do this sale activity is a question. Okay, Baumol model has given answer for these questions. What they said, like in EOQ. EOQ, what I said, if you order so many times, if you order so many times, whenever you need 20 orders, 30 orders like that, you are ordering 20 units, 30 units, 100 units, etc. Okay, then high ordering cost, low holding cost. If you order in bulk once, high holding cost, low ordering cost. Likewise, if you do, okay, if you put huge amount in the marketable securities, if you put a huge amount in marketable, full amount you are keeping, 50 lakhs you need, 50 lakhs you are putting in marketable securities. Are you understanding or not? You have two options now. You are putting in marketable security full amount. Okay. But you are withdrawing by selling in one stretch. By selling in one stretch. If you sell that in one stretch, full amount will become cash. I invested 50 lakhs in marketable securities here. No problem. You invest. I sold all the marketable securities in one day. Okay. 50 lakhs cash will come and sit as a cash. On that, you are losing the return that you will get as a marketable security or not. Yes. But you are doing transaction how many times? Only one time. Transaction how many times, sir? Only one time I am doing the transaction. But if you observe clearly, you are doing the transaction only once. If you are doing the transaction only once, one time only there will be a brokerage charge and other expenses of stock market. But two things are there here. One is interest loss. Second one is brokerage cost. Interest loss, brokerage cost. Means what? I kept 50 lakhs in marketable securities. Okay. Whenever I want 10,000 I want, I will sell 10,000 worth marketable security. 200 rupees I want, 200 rupees worth marketable security I will sell. If you go on selling like this, 100, 200, 150, okay, 1,000, 10,000 like that, small amounts if you do, transaction, you are having transaction cost. Huge transaction cost you will incur. 50 lakhs, if you withdraw 1,000 to 2,000 every day, when it should be completed. So you will have huge transaction cost. Are you understanding or not? Huge transaction cost. But since you are taking only small amounts out of 50 lakhs, the remaining huge cash balance will generate interest. So here one advantage, one disadvantage. Advantage is because of withdrawing small amounts, huge amount is still in the marketable security generating return. Disadvantage is since you are having huge amount of transactions that you are making, number of transactions are very huge, hundreds and thousands you are making, number of transactions, transaction cost will be increasing for you. Second, I am making big amount of withdrawals every time by selling it. When you sell big amount, transaction number will reduce, transaction cost will reduce. But since a huge amount you are withdrawing, you will lose the interest on that cash that is withdrawn. Because if the cash is in marketable security, it generate return. But the cash is in the currency form, it will not generate any return. The disadvantage is the cash don't generate a return, but transaction cost is reducing. So there is an advantage of withdrawing huge amount. There is a disadvantage also with withdrawing the huge amount. At what transaction size I will have the minimum transaction cost and minimum opportunity cost of loss of interest is the topic we are going to discuss. 90% what I said now is already similar to the inventory cost or not. Same. So EOQ in a different way we are going to see. So formula derivation also I am not going to do because already I have done in the inventory management. If you want in the YouTube lecture, it is there, you can see. See the Bowman model. Beginning of the year, a company estimates annual cash requirement say 12 lakhs. C means cash requirement per annum is 12 lakh to meet the expenses. However, maintaining fiscal balances is not recommended since they do not generate any interest or return. Therefore, companies maintain their cash in the marketable securities such that till they are put into use, they generate return and utilized accordingly. Whenever company needs cash, they will sell marketable securities. What is a marketable security? Marketable securities are those securities which are convertible into cash immediately and get the cash needed. Advantage. No unwanted blockage of cash because of maintaining in marketable securities. No unwanted blockage of cash. No risk of pilferage theft. Cash is then people will do that. Okay, they will have that talent. They will steal your money. That theft can be there if it is in the physical cash. But here it will not be. Disadvantage: no clear prediction as to how much cash needed. You will withdraw only small amount, but how much you withdraw, prediction is difficult, and heavy transaction cost to sell the marketable securities for multiple times. To overcome this, Bowman model made an optimum transaction level at which we can have minimum transaction cost. Two situations: if we sell marketable securities in small lots, if we sell marketable securities in bigger lots. If you sell marketable securities in small lots, advantage is less opportunity cost of loss of interest because huge balance is still there in marketable security. Disadvantage: high transaction. Vice versa here. Okay, vice versa here. So to overcome this problem, this Bowman model has emphasized optimum transaction size at which interest loss and transaction costs are set at minimum level and represented by the formula. There you have seen 2CO by I. Here it is 2CT by I. Okay, root of 2 into C, annual cash requirement. In our example, 12 lakh into transaction cost. How much is the transaction cost you are having? That much. 20 rupees per transaction, 10 rupees per, like that. Next, interest cost. Percentage terms we need to write. Okay. 2 minutes time. Fastly brush through the Bowman model. Fast. Completed. Next. I have prepared some illustrations taken from the past exam questions only. Let us see how they are being asked. Projected annual cash usage 37 lakh 50,000. So we assume that it is uniform throughout. 37 lakh 50,000 is not used on Jan 1st, neither on December 31st. Uniformly they will use. Okay. Uniformly they will use throughout the year. Okay. So company periodically sells marketable securities to meet the cash requirement. Marketable securities earn 12% per annum. Cost of transaction in marketable security 40 per transaction. Using the Bowman model, calculate three things. Number one, optimal transaction size means what is the cash amount, what is the marketable securities worth I need to sell every time in order to put the interest loss at minimum, transaction costs also at minimum. Average cash balance, transfer required during the year, annual cash requirement. First, we need to calculate optimum transaction. What is the formula? Root of 2CT by I. You are seeing there, na? 2. C means what? Annual consumption. How much? 37,50,000 into what is the transaction cost per transaction? 40 divided by interest cost. Right in the percentage terms, 0.12% or 0.12. 50,000. How much? 50,000. How to understand this? Company require rupees 37,50,000 of cash to meet its annual expenses. It mobilizes this cash by selling marketable securities. Every time it sells rupees 50,000 worth marketable securities. Okay, next. Average cash balance. Inventory management, like I told you. When I say stock is 10,000, it is 10,000 in the first day, 0 in the last day. Means we should always take the cost on the basis of, okay, beginning, ending, average. Means what? Beginning, 50,000, ending, 0. So average cash balance is how much? 25,000. Okay, next. Transfers required during the year. How many number of marketable security transfer activities should be done? I need 37,50,000. One time I will transfer 50,000. Means how many times I need to do? That is the transaction we have to write down. Okay. So I think I didn't calculate there. Let me calculate. 37,50,000 divided by 50,000. How many transfers we need to do? Write down. 75 transfers we have to do. 75 transactions we need to do. Okay, this is the answer. First answer complete. That's all. 4 marks they will give. So this is how the 4 marks question will come. So annual cash requirement is 37,50,000, interest is 12%, and transaction cost is 40 per transaction. Optimum transaction size you have calculated. Company require 37,50,000. Every time you have to sell 50,000, means how many transactions you need to do? 75 transactions throughout the year. And 50,000 is the amount that you will get today na after 1 year or today na throughout the month. Every single time whenever I want 50,000 I need. First day of the month 50,000 will be there. Middle it may be only 21,000, 28,000. Last it will be 0. That means what is the average cash balance? On that you have to calculate this particular thing. Average cash balance is 25,000. Next. There is a table approach to the same. This is more important in the exam. 4-5 times it is tested also in the recent attempt. Annual cash requirement 10 lakhs. Types of marketable securities the company has. Company is having 5 types of marketable security investment. They can sell in 5 lot sizes. Lot size of 50,000, 1 lakh, 2 lakh, 2 lakh 50 and 5 lakh. Cost of conversion per lot means to sell transaction cost is 1,000 per transaction. Interest cost is 5%. To prepare, required to prepare a table indicating which lot size will have to be sold by the company, means economic lot size. And what is the economic lot size? Separately you have to calculate using Bowman model. This is not Bowman model, bit number 1. It is only basic question. Second one is economic lot size, no Bowman model. The formula has to be applied. First, randomly they have given how many lot sizes? 5 lot, 550,000, 1 lakh, 2 lakh, 2 lakh 50, 5 lakhs. Okay, let us see the fortune of all the 5. See there. If I sell in the lot size of 50, how much is my annual cash requirement? 10 lakhs. Means every time I have to sell 50-50 means how many transactions? 20. If I sell in 1 lakh size, 10. 2 lakh size, 5. 2 lakh 50 size, 4. 5 lakh size, 2. Okay, now what is the average cash balance? What is the average cash balance? 25,000. That means 50,000 50 will not be there every time. Beginning 50, ending 0, average is 25. On that I am losing interest. So therefore, 50,000 into 25,000. Okay, sir, 50,000 divided by 2, 25,000. 1 lakh by 2, 50. So 2 lakh la half, 1 lakh. 2 lakh 50 la half, 125. 5 lakh la half, 2 lakh 50. These are all the average cash. On that, I am losing interest of 5%. So that's a first cost. 25,000 into 5%, 1250. Like that, 5 interest cost. Along with that, 1,000 rupees per lot of transaction. 20 lots ki 20,000. Because lot ki 1,000 na, 20 lots ki 20, 10 ki 10,000, 5 ki 5,000, 4 ki 4,000, 2 ki 2,000. total cost is 21,250, 12,500, 10,000, 10,250, 14,500. Optimum lot size is 2 lakh since the total cost is lowest in this lot. This is how we should do the answer. According to Baumol model, what is the formula? Root of 2 into 10 lakhs into 1000 divided by 0.05. Using that, how much is the answer? Let us see. 2 lakhs. That's all. Means what? Actually, as per Baumol model, you need not do all those things. Directly, you will get this answer. Randomly, they have given this table. Here also same answer you will get. Okay. That's all. That's our optimum size. Next. Next area we are going to start is Miller-Orr model. What is the model, sir? Miller-Orr model. What is Miller-Orr model wanted to tell? Same logic in a different way. Miller-Orr model said that you should put, okay, you should put three kinds of boundaries. Same like material. Reorder level, reorder quantity will be there like that. When you start your business this year, somewhere your cash balance will be. When inflows are more, it will raise. When outflows are more, it will fall. Raise, fall, raise, fall, raise, fall. Like that randomly, they will move on like this throughout the year. Correct? Therefore, what he is telling, whenever inflow is there, it will raise. Whenever outflow is there, it will fall. Raise or fall. Like that, cash balances will fall in a ECG type. Okay, he said that three balances you need to maintain. How many? Three. Lower boundary, upper boundary, return point or repeat point. Anything is okay. Some books will use repeat point, some books will use return point. So return point UB LB. What is LB? LB is the lower boundary to which your cash balance should never reach. Upper boundary is the boundary where beyond that your cash balance should not go. Whenever your cash balance is reaching this upper boundary, okay, that means mounting up. Okay, whenever your cash balances, your marketable securities, whatever the amount that you are having now, if that amount is reaching an upper boundary, cash is reaching an upper boundary level, so immediately what you have to do, you have to dispose that cash by investing in marketable securities. And this level is going below this a lower boundary now. If it is reaching below that, immediately you have to, okay, sell the marketable securities and get the cash. Simply crossing and breaching the upper boundary, invest in marketable securities. Going below the lower boundary, or it is going to reach the lower boundary, immediately sell and get the cash back. Okay, at any point of time you may get a doubt, sir, it reaches the upper boundary, what I should do? If upper boundary is reached, high cash balance is there, invest in marketable security. How much I should invest? You should invest that much amount of cash which should bring back to the repeat point. Say for example, this is 25,000, this is 10,000, this is 15,000 example. Okay, for this also there is a formula calculations. Example, let us see, if your cash balance is going beyond 25 and it is reaching 26, invest and make it, invest and make it 15,000. If it is going below this, if it is reaching this lower boundary or something value, immediately sell the securities and get and back to the return point. Okay, this is what he wanted to tell. See that a treasury manager should invest in marketable securities if he has surplus cash in hand and should sell if he has shortfall in cash. Miller-Orr model helps the treasury manager to understand the timing of his investment and sale and the quantum. When cash balance touches upper boundary, he should invest so much cash in MSEC that balance falls to RP. And when cash balance touches LB, he should dispose or sell MSEC so that the cash balance is again return point. For that, he has made one formula. Okay, he has made one formula. This is a huge statistics involved, so I'm not taking a time for to derive this formula and waste your time. I will just tell you the formula. Remember this for the exams point of view. How much upper boundary I should maintain? Lower boundary plus spread. What is the repeat point? Lower boundary plus one third of spread. One third of spread has a logic na. This is three. All these has a logic. What is that logic that is there? There are three parts totally: lower boundary, repeat point, and upper boundary. Three parts are there na? So they have divided on an average on three. So lower boundary plus one third of the spread amount. But what is spread? Upper boundary means what? Lower boundary plus spread. Repeat point or return point is what? Lower boundary plus one third of spread. Now the question arises, what is a spread? 3 into, means 3 why 3? Three parts are there. 3 into cube root of, what root of? Cube root of 3/4 into transaction cost into CFP. What is CFP? Cash flow variance per day. They will give you the question. Cash flow variance per day. There is a mechanics for calculating cash flow variance also, but not applicable for your exams. Therefore, they will give the cash flow variance in the exam itself. Okay, interest per day, okay, is called as a I. So tell me, what is the formula? 3 into cube root of 3/4 into transaction cost into CFE divided by interest per day. So what is the formula for upper boundary? Lower boundary plus one third, lower boundary plus spread. What is the formula for return point? Lower boundary plus one third of spread. What is the formula for the spread? 3 into 3, 3 into cube root of 3/4 into transaction cost into CFE divided by interest per day. Just apply the numbers now. Minimum cash balance 10,000, CFE 65,000, 62 lakh 50,000, interest 0.025% per day. Okay, because transaction cost you will take per day, na? Interest also they will cover on per day. Calculate optimum LB and UB and analyze. Sir, in exam if they give 12% per annum, you should first convert that into divided by 365. Per day you should convert. Here they have given in the question directly. This is one of the old RTP question, not there even in the study material. If at all a question has to come in difficult way, they will directly dump this question in exam. At the time you should be writing. Okay. So minimum cash balance 10,000. CFE 6250. Interest transaction costs also given. First spread calculation. What is the formula? 3 into cube root of 3/4 into transaction cost into CFE divided by interest per day. So 3 into cube root of 3/4, transaction cost 20, 62 lakh 50, 62 lakh 50 divided by 0.025. This is the amount. What is the upper boundary we need to maintain? 10,000 plus spread. Lower boundary is how much? 10,000. Minimum cash balance is how much? Yeah, lower boundary 10,000. 10,000 plus this much spread. Minimum you should maintain this amount. Repeat return point. LB plus one third of spread 17,125. These are the three limits. Means cash balance when it is going below this, okay, below 10,000 if it is going, immediately dispose and give the cash to 17,125. Okay, when it is reaching upper boundary, you should immediately invest in the marketable securities such that it will again reach. How to write the answer in exam? If this is given, this is given, this is given, or these three answers if you calculate, how to analyze this? If the cash balance is going beyond this 31,646, you should invest in marketable securities. How much? Difference between these two you should invest. Okay, if it goes below 10,000 or it is reaching 10,000, immediately what you should do? You should dispose securities worth 7,215 such that it will reach 17,120 215 again. Okay, this is the idea behind the concept of Miller-Orr model. With this, we have completed cash management as a chapter. That's all. This is all about the cash management. Sir, listen, the problem is you are not even putting a minimum effort to understand the concept. Okay. So you read once, you see one problem, you try to do it, you can do it. Okay. So put some effort in understanding the problem, because after doing 400-500 problems in this particular chapter, one problem if you don't do, SAR problem, SAR problem, SAR problem is what you will get here. You should try once at least. If you try once, you will understand whether it is tough or easy. Okay. Don't think otherwise, but I mean it here. Okay. One problem, two problems also, if you can't do, what is the point in that? So try at least once you see the question bank, once you see the institute material, try it once. 95% of the concepts when covered, that 5% concept, sir, that 5%, that's sir, that 5%. You try once. If you could not do, then you will understand. Attempt you are not doing, you are thinking that you don't understand. So please don't be on that wrong impression. You try once. Are these difficult now? Inventory management, if you understand, this is easy. Inventory management, costing unit is there. But I taught again. Just for the reason that it is there. Okay. So try. You will get the answer. So anyway, this is the end of another chapter called as cash management. As I promised, I completed this area also in 45 minutes. So this is the idea behind cash management. Any problem may come, that will come only from the point of view of the ideas which we are going to discuss now, and we already discussed now. Okay. So this is the end of cash management. Next one, I will be coming up with the payables management as well. What one? Payables management. This is also similar to this, very easy. Payables management also will come up. Okay. With that, you can also take clarity as to what are the questions that can come in examination. Clear? So thank you very much. All the very best. Prepare well.